Okay, everybody, let's get started with our Chapter 14 review. So, Chapter 14 had two important topics, okay? Bonds, okay, and long-term notes payable. So, let's start at some important topics when dealing with a bond. So, we want to know, first of all, the different types of bonds, okay? So, that's important, okay? Again, we can just start and just go through the pages, okay, just to get an idea of things. But if we start on page 921, that just deals with the different type of bonds that are available. So we might have a term bond or a serial bond, secured and unsecured bonds, convertible bonds, and callable bonds, okay? Also registered bonds and bearer bonds. So I'll let you look up the different definitions of those on your own, and you can go from there. I mean, that's something you'd see on a multiple choice type of question. Gives you a scenario. This bond converts to 1 million common shares. Well, what would that? Well, obviously it's a convertible bond. Okay. So that deals with the types of bonds. And no, again, maybe take a look at the advantages and disadvantages of bonds as well. Okay. That was on page 920 and 919. So from there, once we figure out the type of bond that we're dealing with, okay, we want to get into how do we issue the bond. Okay, so in this case here, okay, now we're going to start on page 924. Okay, so we got to look at the scenario. How are we selling this bond? Are we going to sell it at par? Okay, at par means the bond rate is equal to the market rate. Okay. Now again, go to the top of page 954 and you'll see the example. Now when I say bond rate, I also mean the contract rate. Okay. So if the bond rate is equal to the market rate, we sell at par. If the bond rate is less than the market rate, we sell at a discount, and if the bond rate is greater than the market, we sell at a premium. Okay. From there, we want to figure out how do we do the accounting for the bonds. Again, we have to figure out the present value of the cash flows, which is your interest plus your principal. Okay. The present value of your principal and your present value of your interest payments. Okay, so we're going to want to know how to record that, debit cash, credit bond payable, and depending if it's at a premium or a discount, we will have a discount on bond payable or a premium on bond payable. Okay, so that'll set up the issuance of the bond. From there, we want to understand how we record our interest payments and how we make our carrying value adjustment depending on how we're amortizing that premium or that discount. Okay, and again, this stuff is all in the book. We can go right to page 924. Now we're going to skip out on issuing bonds between interest dates. Okay, if we had time, I would get to it, but we don't. So we're just going to ignore this term. Bond pricing, again, we're dealing with the bond pricing or valuation pricing, whatever you want to call it. Okay. And now we're going to look at, again, we looked at the discount or the issuance, whether it's a discount or a premium. Now we want to get into the recording, okay? How do we record those journal entries or the accounting for it? Well, we want to make a amortization table. So we're going to use the effective interest method, okay? So if you look at the example on page 932, that's going to set up your amortization table using the effective interest method, okay? Once you make that amortization table, this is very easy because you're just picking off your numbers. Then you want to know how to do your last entry, which is your retirement entry of that bond. So you're going to retire that entry by either maturity, because it just matures at the end of 10 years, you got to pay it out. Before maturity, we're going to touch on that one just because we're running out of time. Or you can convert that bond to shares, and that'll be in the bond purchase agreement. Okay, you're just swapping the payable out for common shares. Lastly, we have notes payable. Okay, we want to know the different types of notes payable and how we do the accounting for a long-term note. Okay, so we're going to do a quick, not a quick review, but it'll take as long as it does, but we're going to review bonds, the type of question we would see on the exam. Now, just a reminder, okay, so our in-class questions that we did were 14.1, 14.3, 14.4, 14.6, 14.9, 14.11, 14.16, 14.17, and 14.19. Okay, we did exercise 14.1, 14.7, 14.8, 14.23, 14.25, and 14.26, and we did problems 14.7a and 14.10a. All right, so what I want us to do is I want you to go to page, I had it marked here, 975. So I assigned this one right here, problem 14.7a. Why did I assign that question? Well, because it's something that we'd get on an exam, okay? Now, in order to do 14.7a, you have to do 14.6a. No problem, we can do that, okay? I'm just looking around here in my studio for this whiteboard eraser. You know, I had my reservations as to how this whiteboard would turn out. I guess that's not too bad. It's not as good as a classroom setting would be, and a whiteboard in a classroom would be, but you know, again, we have to make do. I ran around, I was looking in the garbage, all kinds of garbages for this piece of plexiglass, and I found one, and I had to paint the backboard and things like that. So it works, but again, obviously I'd rather be in the class. So let's take a look at this question. 14.7 says, record the following entries: the issuance of the bond on June 1st, payment of the interest on December 1st, adjusting entry to accrue bond interest and discount amortization, and payment of the interest. Okay, so we can't do this until we figure out, are we issuing this on as a premium or a discount? Okay, why? Because we got to look to 14.6a. So 14.6a said on June 1st, She Bandoan investors issued a $4.9 million 7% 3-year bond, interest paid semi-annually, December 1st. So we've got to figure out, again, this is 14.6, because we need to do 14.6 first. So calculate the issue price, assuming the market interest rate is 8%. Okay, so we're going to take our principal and our interest payments. Okay, so the principal of the bond, or the face value of the bond, is $4.9 million. Okay, now that's the bond, we issue it at that amount. Okay, now the next question is, what's the interest rate? Well, we're issuing our bond to pay out 7%, market's 8%. Okay, so bond is 7%, market is 8%, the term is 3 years, and the payment frequency is semi-annually, twice a year. Okay. So if we see that the payment is twice a year, what happens all of a sudden? Divide by 2, divide by 2. Okay, so we're going to get a bond rate of 3.5% and a market rate of 4%. We're going to use those for our calculations. A term of 3 years means we're going to make 6 payments. Okay. All right, so secondly, what's the interest payment that we're going to pay the bondholder every 6 months? Well, $4,900,000 times 3.5%. You can do this calculation one of two ways. You can go either 4.9 million times 7%, which will give you 343,000. Then divide that by 2. Why divide that by 2? Because you're getting that yearly interest rate, but you're getting it every 6 months. Okay. Or you could have just went 4,900,000 times 3.5%. It still would have got you 171,500. Okay. However you want to do it, just make sure you do it right. Okay, now what? From there, we got to use our present value tables, okay? But our present value tables, we use the market rate. Market rate 4%, 6 payments, okay? So let's go to our present value table. So to figure out the present value of the face value of the bond or the principal, okay, we're going to use the table 14A-1, top of page 960. Again, we got to use the market rate for this calculation here. Okay, I'm just going to put this up here. Let's see, 4%, 6 payment, PMT. Okay. So as a result, 4%, 6 payments is 0.7903. Now we got to do the same thing for the semi-annual interest payment, but we use the second table. Again, you can see here I've marked it. The first table is for the principal or the face value. The second table is for your interest payments. And again, for this calculation with bonds, we always want to use the market rate to calculate the present values. Okay. So again, we're just going to go 4% at 6 payments. Okay, right here, 5.2421. Okay. Now from there, we're just going to cross multiply, and that'll figure out our present values of the cash flows. Okay, so 4.9 million times 0.7903 is 3,872,470. Okay, the interest will be, actually I'm gonna 3,872,000. I get 470. The textbook gets 541. This is due to rounding. I'm just going to keep it consistent with the textbook. Okay. Now, same thing for the interest payment, 899,027. Let's see if I 171,500 times 5.2421. 899,020. They get 027. This is a rounding issue. That's why it's different. So we'll just use their numbers. It's fine. Okay. From there, add that up. We are going to get the amount that we actually sell the bond for. Okay. So even though it's face value of 4.9 million, we're going to receive cash of 4,771,568. Now, going back to the question, I lost the page. Bear with me. That's the thing about doing a video with an iPhone. You can't press pause, or you're making 2 and 3 videos. I learned that after posting a few videos before. The awkward thing is now I'm flustered because I'm trying to find that question and I didn't mark it properly in my book. You know, it's kind of nice working at your own pace, but I find it very, I don't know what the right word is. Anyways, it just, you're doing everything twice. It makes for a long day. So calculate the issue price of the bond assuming a market interest rate of 8%. We did that. This is 14.6A right right here. Okay. Now, second part of the question. Using the effective interest method, prepare an amortization schedule. That's important. Okay. We need that amortization schedule, okay, in order to make our journal entries. Okay, so what I'm going to do here is, I know that this is my number. I'm going to erase this top information here and make the table, okay? Just because there's not enough room. Obviously, if we're in the classroom, we'd have the giant whiteboard, but we don't. Okay, so with this information here, again, we know that we've issued the bond at a discount. Why? Well, because the face value's $4,900,000. We can only sell the bond for $4,771,568. Why? Well, because we're offering 7% yearly, the market's offering 8%. So who would ever want to buy our bond? Okay, they only want to buy it if we can give it to them at a discount. All right, so let's make our table. Again, that table is very similar to what you would see in the textbook. I forget what page it was I told you. I don't want to go back and forth on all these pages because it's just awkward doing a video on this desk, but whatever. Leave it be. Okay, so find that table. Find the amortization table dealing with the effective interest method and make the amortization table according. So period. Then we're going to have our interest paid, our cash interest paid, let's put it that way. Okay, so the cash interest paid is always going to be $171,500. Okay, so our first period, we issue it on June 1st. I want us to learn the basics. I don't like this question because they issue it on June 1st and you're going to have to accrue a month's worth of interest. Anyways, so it's not, I would have liked it to be July 1st. Then we wouldn't accrue anything. December 1, June 1, December 1. I'm just going to do the first 4 periods, okay? All right, so the cash interest paid will always be, in this case here, $171,500. Okay. Now, again, we're setting up our columns. There's 6 columns that we have to use. Okay. Now we have our period interest expense. Well, how much does that be? Well, we don't know yet. Okay, we'll figure it out. Then we have our discount amortization. It's hot in this studio. I should have worn my shorts. Unamortized discount. And then finally, we have our carrying value. Okay, so our opening carrying value, in this case here, is $4,771,568. That's what we calculate. It's the present value of the payments, of the cash flows, okay? And our discount is going to be $4.9 million, which was the face of the bond, okay? Minus the carrying value, the opening carrying value. So $128,432. Now we can start making our journal entries. Or not our journal entries yet, but we can start filling out our table. Okay, so the first thing that we want to do, we want to figure out what's our actual interest expense? Okay, so the interest expense, we always use the market rate. Okay, so we only use the bond rate to figure out the cash interest paid. Everything else we use the market rate. So 4%, again, why are we using 4%? It doesn't say 4%, it says 8%. Yeah, but it said there was a semi-annual payment. Okay, so we gotta divide that by 2. Okay, so 4% times the beginning carrying value or the closing carrying value from the prior period. Okay, it's like this. 4% times 4,771,568 is 193,863. 190,863. Okay. Again, 4% times the opening carrying value. Now from there, what's the discount amortization? Well, it's simply 190,863 minus 171,500, which is going to give us 19,363. Okay. Now, okay, we got this here and this here. This is going to be for our journal entry to record the issuance of the bond. This information here is we're going to use that to make every semi-annual journal entry related to this bond and the amortization of this bond. Okay. So what's the unamortized discount? 128,432 minus 19,363 to give us 109,069. Okay. As a result, the carrying value goes up, okay, to 4,790,931, okay, which is basically your carrying value plus the discount amortization. Because eventually what you want this to happen is you want this to increase until you get to $4.9 million, which was the face value of the bond. So eventually you're going to get up there, and eventually this here is going to get down to 0. Your discount amortization is going to get up to, once you add it all together, 128,432. Okay, and you'll see that from the answer key that I gave you. Okay, so now let's go to, we figured out June, I think that's for 2020, yeah, 2020. Okay, I'm just gonna fill this in, 20, 20, 21, 21, 22. Okay, so let's figure out what's the interest expense for June 1st, 2021. Well, again, 4,790,931 times 4%, okay, is gonna give us an interest expense of 191,637. Notice our interest expense is increasing. Why? Because the interest expense is based on the carrying value of that bond, which increases over time. Now, if we were doing a issuance of a bond at a premium, everything's reversed. Okay. In these columns. Okay, where we're going from here up, we go from here down if it was a premium. Okay. Anyways, so we have enough information. So what's the discount amortization going to be? Well, 191,637 minus 171,500 is 20,137. Okay. Our unamortized discount is now 109,069 minus the 20,137. Sorry, it's the 191,637 minus 171,500 gives us the 20,137, and then from there we're just going to take that amount here off our unamortized discount. okay? So that drops to 88,932. And then the carrying value goes up by the amortized discount. Okay, so now we're sitting at 4,811,068. Okay, again from there, now we have enough information. We can do December 1st. What is that going to be? Well, the interest expense for December 1st, 2021 is 4,811,068 times 4% to give us 192,443. Okay. The discount amortization, okay, will be 20,943. Simply taking 192,443, the period interest expense minus the cash paid. Now, what's the unamortized discount? Well, it's going down. It's going to go down roughly to, I don't know, 68,000. 67,989. Okay. And then from there, again, our carrying value is going up and up and up and up until we get to 4.9 million. So we add the discount amortization to the carrying value, and we are now at 4,832,11. Okay. And we would just keep on making. We've done 3. We'd have to make 3 more. Follow the same steps again, and eventually we'll get all these numbers. Take a look at the answer key. Okay. Now we figured out that information. So again, this is going to be on the exam. We know how to calculate the sales price of the bond, okay, or the issuance of the bond. From there, let's go to 14.7. So this is a similar exam type question, guaranteed. Okay. So now, record the following entries for 7A. Okay, the issuance of the bond. Now, do they use letters? Yeah, they use it. So this is A. Okay, so record the issuance of the bond. Okay, easy enough. It's all right here. We're going to issue the bond, debit cash, 4,771,568. Okay. Now, our bond payable is going to be the 4.9 million. So remember, we're going to pay at the end of the 3 years, we're going to pay back $4.9 million, even though we only sold the bond for $4,771,568. The difference, 128,432 is the discount on bond payable. This should have been bond payable too. I don't know if I said bond premium. So a discount on bond payable. So that sets up the issuance. Now let's go to B. Record the payment of the interest. Okay. All we're doing is this. Okay. So December 31. Okay. How do we make this entry? Well, December 1, sorry. We're going to take this information, okay? So our interest expense is going to be $190,863. Okay, now we want to amortize the discount on the bond payable. Okay, so we're going to take this amount here. $19,363, and our cash payment, because we got to pay interest, but the cash that we're going to pay the bondholder is only for $171,500. Okay, And we'll just keep on making that journal entry over and over and over, well, not over and over, but 5 more times. Obviously with different numbers. Now what's the June 1st, 21 payment gonna look like? Same thing. Okay, the cash payment's always gonna be 171,500, but we're gonna have different interest expenses. The interest expense will be, in this case here, 191,637. Okay, and the discount on the bond premium will be 20,137. Okay, again, so that would record all your journal entries. I want us to ignore part C, okay, where it says make the adjusting entry to accrue bond interest and discount amortization. Because they sold the bond in the middle of a calendar year, it doesn't jive with their fiscal year. Let's just ignore that and assume that their year end is December 1st, okay? That makes it easier, then we don't have to accrue for interest. Now, after that, we make our 6 payments. We want to retire the bond. How do we retire the bond? Now, it doesn't ask us this in B or C, C or D, but I'm just going to show you how to do it. So your very last entry to retire the bond would be debit bond payable for $4,900,000, credit cash $4,900,000. Okay. If you can do this entire question like I just did, okay, price the bond, okay, do your present value calculations, make your amortization table, make your journal entries, you'll have no problem on the exam, okay? All right, now, the last question was, or the last major topic was dealing with various types of long-term debt. It's the question that I was going to take a look at. I don't even know if we really need to, but it's exercise 1425, okay? So if we look at this just briefly, I'm going to look at the answer keys, okay? And just kind of go over the answer key with you rather than talk about it on the board. I might jot some important notes down, but I'm just looking here, 1425. Okay, so it says here, calculate the size of each of the 4 equal payments. Well, in order to do the 4 equal payments, how much are the equal payments going to be? We have to take the initial balance, which is $100,000, times the present value table, which is table 14A2, okay? So in this case here, just let me erase this. Okay, so $100,000 times what? This is 1425. Well, again, go to the present value table. We have a note here that we're going to make equal payments on. 4 years at 5% annual payments. At the end of each year. Okay, that's important to figure out when we make these payments. Okay. So again, we're going to go to present value table. Now, since these are multiple payments, we use table 14A.2. Again, I've marked it as interest payments using a bond, but if we're doing a long-term note payable, you use the second table because there's multiple payments being made. Okay, so we'll go, in this case here, the question said that the note had a 4-year 5% note. Okay, so 4 years at 5% is 3.5460. This should not be a multiply, this should be divided, okay? So what happens? 100,000 divided by 3.5460 is 28,201. So what this means is we're going to make 4 payments of 28,201. Inside that payment of 28,201, well, we know what's going to be interest and what's going to be principal, okay? So over the life of this loan, we're going to pay interest of 12,804. Well, why? Because we're making payments of total payments is 28,201 times 4. So that's 112,804. And our face value of our loan was 100,000. The difference is 12,804, which is the interest. Okay. Now, okay, great. So we know what the interest is going to be, but that's the total interest that we're going to pay, not the interest that we're going to allocate on an individual basis to each period. Okay, so we know our total payments, including cash and interest, is 28,201. How do we record the journal entry? Okay, well, we've got to make our amortization table like you see on the answer key for 1425B. Okay, so we know again that our payment is 28,201. If we set up our amortization table, then we can figure out what our journal entry will be. Okay, so what's the interest expense? Okay, so the interest expense for 2021 is 5% times 100,000. Cash payment will be 28,201. Okay. As a result, the difference is the loan. Okay. Long-term note, which is going to be reduced now by 23,201. Okay, so that's journal entry number 1. Well, journal entry number 2, because journal entry number 1 would have been debit cash, credit, note payable. Okay. So from there, you can, if you go and look at your amortization table, what's left? What's left on the debt? 76,799. How did we get that? Well, 100,000. And again, I need you to make the table. I'm not. I just don't have enough room on the board. Minus the principal, 23,201. Okay. Again, the ending balance after our payment is 76,799. Okay. Now, if we want to make our next journal entry for 2022, so this is 2021. For 2022, it's the same thing. Okay. Our cash payment is always going to be 28,201. Okay. Now, times 5%, 76,799, because that's what's left on the borrowing. Okay. 76,799 times 0.05, 3,840. Okay, so 3,840 minus 28,201. The principal, okay, that's going to come off the liability that we owe for this note is going to be 24,361. So after at the end of 2 years, again, compare this to your amortization table on the answer key. Your ending balance is 52,438, which you will then use for 2023, and you'll just keep on making those journal entries, again, until you make 4 cash payments. Okay, so that wraps up chapter 14. If you have any questions, please email me and I will help you out. Likely what I would do is I would just make another video and send it back to you. I think that's the best way, but everyone's learning at different paces here. So again, if you have any questions, please let me know. Otherwise, have a good weekend and we will see you on Monday.